Good afternoon, everyone, and welcome to this TradeStation webinar. It's great to see so many familiar names already in the attendings list. Thank you for taking time out of your schedules and attending this webinar. There's a lot of information that we're going to cover today and very interesting information. As you can see, I'm joined by a colleague. His name is Matt Cashman. For a moment I went blank. Matt, sorry about that.
I love it. I love it. That's right. I'm here.
Yeah,
I'm here,
right.
Jesus. Regardless of whether or not you remember my name, I am here.
We're gonna pass the microphone over to him in just a bit, so just hang on tight with me. I'm gonna go through some introductions and some disclosures, and then we'll get the presentation started. As I said before, Matt Cashman is our guest speaker. He is from the OCC and OIC. Altogether, they combine a great entity that provides great educational content to options traders. My name is Jesus Nava, Director of Client Training and Education for TradeStation Securities. Always a pleasure to doing these classes for our traders. Keep in mind that every symbol and idea that we talk about is for educational purposes only. These are not recommendations of TradeStation. Also, active trading is not suitable for everyone, especially when it comes to trading options, which carry a high degree of risk. Also, Matt, it's a pleasure to have you here, but he's not affiliated with TradeStation. His ideas and his education are his own, but they're all coming from the OIC, which it just puts a stamp on it. So if you need additional information on our disclosures, please visit www.tradestation.com/important-information. Matt brings over 20 years of trading experience and educational experience, so it's a pleasure to have him here with us today. He's an expert on derivatives market, and in today's presentation, we're going to touch on a topic that is not for the faint of heart. It's an advanced topic, but it does talk about put-call parity and how we can take advantage of market inefficiencies. Matt, I'm going to stop my sharing and pass the microphone over to you. Thank you so much for being here, Matt.
Thank you for having me. Let's get my slides up and running. Jesus, I appreciate the intro. Hello, everyone. Thank you for joining us for today's TradeStation OIC webinar on option conversions and reversals. The goal of this presentation is to give you a really solid understanding of these more complex option spreads and to build on some of the knowledge that we created in our previous webinar, like the one on synthetic strategies. We just talked about that last time, and hopefully it's going to help you to build and create a more cohesive idea of how this whole thing fits together. Synthetic strategies are really substitutions for directional trades within the options ecosystem, but obviously they include options. So they include, optionality and the leverage that's inherent with options and the flexibility that leverage provides, but they also carry the risks that come with that optionality. So that doesn't exist in a straight delta trade that you would have with a stock position. But we're going to build on that today and add synthetic strategies and the deltas that you might create there. And then we're going to add that delta from a actual physical stock position against it. The more you understand about these risks and benefits and the dynamics, the more you're going to be able to translate it to how you're looking at the options and figuring out why they might be moving in the way that they are, because that's really what we're going to try to get down to here. Options are incredibly diverse and flexible, but you need to understand the leverage that exists within there. Let's get to the disclaimer on my side. Options involve risk, yada, yada, yada. Any strategies discussed, et cetera, et cetera. OCC makes no recommendation with respect to, you know the drill of the disclaimer. These are the trademarks that you're going to see throughout my presentation. Quick note about OIC. What you're seeing here is the website optionseducation.org, where all of our educational resources are housed. And this email address, options@theocc.com, is an email address that's staffed by myself and 3 other options experts. We answer questions about options all day long. If you have questions, please send them to us. We're not registered investment advisors, so we can't help you with your exact position. But what we can do is teach you and talk to you in somewhat generalities about how these options positions generally work, and then help you to use that information to make better informed trading decisions, because that's basically what we do. at the OIC, is teach people how options work. This is the volume chart for options volume over the last 25 years. You can tell it goes from bottom. I always put this at the beginning of my presentations because it's important to draw a picture for everyone to understand how many more people are involved in the options marketplace and in what frequency they are involved. It's a large number, 12 billion contracts plus last year. It's the first time it's ever been over 12 billion contracts of cleared volume by the OCC. It's important from my seat as an educator that everyone who's in there trading those 12 billion contracts understands the actual inherent risks and the leverage that's inherent within the options that they're trading. So with that said, we're going to dive into some pretty dense material, particularly in the second half of this. The first half is going to be somewhat of a review of some of the concepts, like I said, that were in the synthetic strategies that we did last time. So we're going to talk about put call parity, but then we're going to pretty quickly dig into conversions and reversals. What are they and what are their component pieces, the building blocks of those strategies? One of the big component pieces of this is that synthetic part of the actual delta, the synthetic part which is created by the options. And the options actually create what I call an implied forward stock price. I'll tell you what that means. I'll give you some examples of why that even matters. And then we'll talk about what the dynamic is when you actually put an implied forward price against a physical stock position and hold them against each other, and what some of the risks are there, because there are interest rate risks and dividend risks and all kinds of risks that you need to keep in mind when you're talking about it. But this is, like I said, particularly the second half gets pretty dense, but let's get started right away. Put call parity. Many of you may already know this like the back of your hand. If you've been trading options for a while, put call parity is a concept that describes the relationship between calls and puts on the same strike. Knowing the value of the call can imply the value of the put, and knowing the value of the put can imply the value of the call. That's how put call parity works. It holds those prices together, that through supply and demand, that the actual prices stay in relative sync with each other, and that forward implied price that we're talking about is intentionally, theoretically put where it supposedly needs to be. Call side, but generally speaking, put call parity keeps our bid-ask spreads tighter, and it makes the pricing irregularities as minimal as possible, because if they stay too far out of whack for too long, people generally put them back into whack through an actual supply and demand dynamic that exists there. The other part of put call parity is when you think about put call parity and the call price and the put price and the stock price, those three things, you're going to see that triangle used a lot here. It creates what we call synthetic positions. This is what I covered in the last one. Synthetic stock positions are created through calls and puts. I'm going to get into both synthetic long and synthetic short stock positions as a review here before we dig into conversions and reversals. But really what you're dealing with are calls, puts, and stock. That's essentially the three pieces of this synthetic position. I'll show you how you can combine them to create synthetic long stock and synthetic short stock. Let's talk about the simple put call parity formula. This doesn't necessarily factor in every single risk metric that we're talking about, but I want to give it to you in a very simple way so you can look at it, especially if we use it when we're talking later on about finding the actual implied forward price. So call minus put equals stock minus strike price. If this doesn't add up in some way, there's probably an arbitrage going on here, or a discount factor that you need to look at. Some of the discount factors that we're going to talk about in depth later on in this presentation are interest rates or carry costs and dividends. Those are two big things that we're going to cover at the end of this presentation. I'm going to give you some real life examples of what that looks like and how you might be able to spot situations where these discount factors are at play. So let's talk about conversions and reversals. What are they? Conversions and reversals are essentially synthetic stock of some kind, either long or short, versus physical stock. of some kind, either long or short. Conversions and reversals combined those two things against each other. Generally speaking, they combine them in a what we call delta neutral way, meaning if you're carrying 100 shares of stock, you're probably carrying, if you want to be delta neutral, 100 shares of a synthetic stock position. Now, most of the time when you're dealing with equity options, 100 shares of synthetic stock would be created by having one call and one put on the same strike, because each one of those options is an option to exercise or be exercised, to be assigned on 100 shares of stock. So that's why they are created one for one most of the time, because that's how you create it in a delta neutral way. The conversion strategy specifically is the long actual stock position paired with synthetic short stock. The way that I kind of figured out 20 years ago how to remember this, because I couldn't, my brain sometimes works in different ways than most people. Some of the people that were going through the training class with me in 1998 that when I started trading options didn't have a problem figuring out whether it was a conversion or a reversal. I had a problem initially and was like, I don't understand, which one is this? Is it conversion or is it a reversal? Here's how I figured out how to remember it. It might help you, it might not. Conversions are long actual stock. Always remember, what am I doing with the actual stock position? If you're long actual stock, physical stock, you have what's called a conversion on. If you are short the actual synthetic stock, or no, if you're actually short the, to this day, I still, if you're short the actual physical stock, you have what's called a reversal on. There you would have short physical stock and long synthetic stock. We've got that covered. Conversions are long physical stock. Reversals are short the physical stock. Let's focus first on these actual synthetic stock positions. How do you create synthetic stocks? Long synthetic stock is generally created through long calls and short puts on the same strike. So if you want to create long synthetic positions, you add a long call and a short put on the same strike to get long synthetic stock. That looks like this from a risk P&L perspective. Both of those trades have what we call long delta associated with them. So when you add them together, what they end up with is P&L characteristics of a long stock position. This is your long call P&L. This is obviously a very general P&L graph, but I'm putting this together to try to drive the point home that long calls plus short puts on the same strike equals long synthetic stock. If you take the actual diagonal part of this graph, the diagonal part of this graph, and you add them together, what do you get? You get something that looks an awful lot like a long synthetic stock position. It looks exactly from a P&L perspective like a synthetic long stock position does. Now, conversely, if you're looking for synthetic short stock, you have to do, guess what? The exact opposite. Short synthetic stock is created through short calls and long puts, but again, on the same strike. We're talking about adding short calls and long puts on the same strike to get short synthetic stock. As you might imagine, short calls and long puts equal short synthetic stock, just like the other side equaled long synthetic stock. You've got short calls plus long puts. That looks an awful lot like a stock position. It looks an awful lot like a short stock position from a P&L perspective, and that's why we call it short synthetic stock, because that's basically what it is. So now that we've covered those, that's the synthetic part of this. How do we calculate the implied price of the synthetic stock from the prices of the option? So if you have a short call and a long put on the same strike that you're creating short synthetic stock, you have to think about, like, where am I creating short synthetic stock? From what price am I creating short synthetic stock in that situation? This is when you use the calculation for implied forward stock prices. And it's very, very simple, but some people have a problem thinking about it in a simplistic way because there's a lot of numbers involved here, admittedly, but I'm going to try to break it down for you in a very simple way. Call minus put plus strike equals the forward price of the implied synthetic. That's basically all it is. If you look at the call and the put, call minus put plus the strike that they're on. Keep in mind, these always have to be on the same strike in order to create full synthetic positions. Call minus put plus strike equals implied forward price. You can use this to calculate the implied forward value for synthetic stock executed at that strike. So if you're looking at a 30-day option, call and put on the same strike, the implied value of the synthetic stock position that you might be able to create by trading those two prices can be calculated for the next 30 days, right? That if that's a 30-day option, according to these option prices. Now, let's look at some examples of how this might play out in the actual marketplace. The implied forward price of the synthetic stock, again, is calculated using 3 data points only. What are they? They are calls, puts, and the strike price. That's all they are. In this case, the strike is 50, the calls are trading 5.5, and the puts are trading 4.5. Very simple. So let's use the simple strategy, the calculation that we just talked about. Calls are trading over puts in this situation, meaning the call price is more than the put price. I'm not going to talk about where the actual stock is trading necessarily, because I want to break this down into just like, how do we look at where the options are pricing the forward, which is essentially what this is. And then we'll talk about where the stock is trading against that. The physical stock is trading against that, because that's the other part of this. That's the how you create the conversion or reversal, or how you take advantage of that interest rate difference that we're going to talk about in a bit. In this case, 5.5, 4.5, and 50 are the 3 data points that we need. 5.5 minus 4.5 plus 50. Remember, call minus put plus strike equals forward price. In this case, you can look at this and say the forward price of the synthetic stock is being implied as 51 bucks. Why? Because the call is trading 1 over the put. That's the simplest way I can kind of drive this point home. Things get a little bit more complex from there, but let's look at a different example that has puts over, because it's basically the same thing. In this situation, the puts are trading over the calls. Puts are trading more than the calls. Generally speaking, that means that the stock price, the actual physical stock, is trading under the strike price. Whereas in the previous example, generally that shows that the actual stock, the physical stock, is trading over the strike price. Not always the case. I'll talk about that a little bit later. But in this case, again, same formula. Call minus put plus strike equals the actual forward price. So in this case, you can see 1/2 minus 4/2 gives you -3. Add 50 to that and you get 47. Why? Because the put is priced higher than the call. And like I said, that implies that the prices of the options are telling you that the actual forward price for however long this option exists right now is priced at 47 instead of 50. Now, let's talk about conversions and reversals as a function of this. Again, conversions and reversals, which one is which? Conversions are actual long physical stock paired with short synthetic stock. Reversals are short actual stock, short physical stock, paired with long synthetic stock. So let's take a look at their actual P&L dynamics as it pertains to when you put these two things together, the synthetic part that we just talked about and the actual stock position, whether it's long synthetic and short physical stock, or short synthetic and long physical stock. The value of the stock in the open market, the actual physical stock, is going to be different most of the time from the value of the implied forward. Those two prices are usually going to be different. Now, what does that mean? That means that if you're trading one of them versus the other, you are creating a spread trade between them. And you are trading, and for as long as you carry both of those, you're carrying the actual spread between them. That's part of the reason why conversions and reversals are often talked about as a spread trade. They're basically 3-legged spreads: calls, puts, and stock. Just like we talked about at the beginning when we were talking about put-call parity. Conversions and reversals are a spread between these, and gains and losses can be experienced if the spread narrows or expands, depending on which way you have it on. If you're short the actual spread and the spread expands, you're probably going to lose money. And if you're long the actual spread and the spread contracts, guess what? You're probably going to lose money. The opposite is also true. If you're long the spread and it expands, you're probably going to make money. We'll talk about why these spreads expand or contract in a moment. How does a spread between a synthetic stock and an actual stock expand or contract? Theoretically, the physical stock and the synthetic stock should move in lockstep, and usually they do. However, oftentimes things that move them in different ways, there are different factors that can affect how the synthetic implied forward is affected differently than the actual stock itself. These are discount factors that we talked about before. Let's look at two of those major discount factors. So the things that you're going to really need to be on your radar when you're looking at why is the synthetic price different than the actual stock price because of the options, you need to look at the first two things that I think you need to look at are interest rates or carry costs and dividends. We're going to talk about both of those individually. This is where things get a little bit more dense. So, interest rates or carry costs and the effect on the implied forward price. Notice below, I'm giving you two examples. One of them on the left is going to be 4.32% of risk-free rate for 30 days. And on the right, the same exact setup. The only difference is the interest rate is 8.32% for the 30 days. I know that that's a big difference. I know that we are not in an interest rate environment where rates, especially the risk-free rate, are 8.32%, but it's chosen to show the difference and to give you an idea of what that looks like and why it moves the way that it does. So remember, call minus put plus strike equals implied forward price for the options. When we're looking at option prices, we're trying to figure out where does the market think this stock is, what the stock or what the amount of money that you have to put to use in order to buy the stock or sell the stock right now, how much is that worth over the next 30 days? So with the 4.32% interest rate, this is a screenshot from the OIC option calculator, which is a very well-used tool on our website. It's probably the most popular page on the entire website. You can go in and create these scenarios where you can actually change, you can pull it down from an actual stock index or an option symbol, but you can also go in and make changes to all of these inputs over here. I want you to pay attention to the fact that I've created this with the stock price at 215 and the strike price at 215. 30 days to expiration. The implied vol is the same on both of them. But the only difference, I've also not put dividends in this example because we're going to talk about dividends in a second. The only difference between these two examples is this right here, the interest rate, 4.32%. Now, this is for a 30-day option. Remember, a 30-day option. When you put this in, the 215 calls and puts are over here, the calls and the puts. This also gives you all the Greeks for them. But what we're really paying attention to here is where's the implied forward price? What are these options telling me about what this might be worth in 30 days? The amount of the big block of money that I have to sink into this for the next 30 days. That's essentially what we're talking about. In this case, the 215 calls are 9.13 and the puts are 8.39. That's with a 4.32 interest rate. So calculate the implied forward, just like we talked about, call minus put plus strike. And what you get when you do that, 9.13 minus 8.39 plus the strike, is that the implied forward price is trading 215.74 with the stock price trading 215. I want you to remember that. That's obviously more than the strike price, but the reason why is because the interest rate is positive. It's telling you that the marketplace thinks that the amount of money that you need to create this is going to be worth more in 30 days than it is right now. It makes sense. if you're thinking about putting money into a savings account and they tell you you're going to get 4.32%, you have a calculation in your head as to what you think that account, if you put 100 grand in it, what is that account worth after 30 days? It's worth the actual amount you put in, the principal, plus the interest you're getting paid on it. That's the exact same concept that's at work here. It's just a little bit more complicated because it's expressed as a call value and a put value. Now let's look at what it looks like when the interest rate is 8.32%. Again, this is the exact same setup, but we have a different interest rate right here. You'll notice everything is exactly the same except the interest rate. Same amount of days, same strike, same everything. And what you see when you jack the interest rate to 8.32% is that you get a completely different forward price. That's not that surprising. If you were to think about it, the example I just gave you, 100 grand in a bank account with a 4.32% interest rate after 30 days, and 100 grand in a bank account with 8.32% over 30 days, it's going to be a different number at the end of the 30 days. Guess what? It's a different number here as well. This is 216.41 when you do the same implied forward price. So you've got a difference of 74 cents here from the strike, and you've got a difference of 1.41 here from the strike because of the difference in the interest rate. Now, let's do that calculation just like we just did. These are all exactly what I just showed you. 215.74 for that 4.32% interest rate. And on the 8.32% interest rate, 216.41, $1.41. Now we're going to calculate from these two prices, these two forward prices, what's the price of the conversion or the reversal? So let's assume that you have these prices for the options that create the synthetic part of your actual position, and you're going to trade physical stock against them at the strike price of 215. So now what do we do here? Calculate the spread, the cost of the reversal. You've got the cost of the synthetic. Now you actually subtract the price that you're selling the stock at, 215. And so in this case, the spread, the difference between the synthetic stock and the actual physical stock, is the price of your reversal. Or if you were to do this all backwards, it would be the price of your conversion. So in this case, the price of the reversal, the cost of the reversal, is 74 cents on a 4.32 interest rate. If you were to actually calculate the price over here, you would get, guess what, 1.41. It's the difference between where the synthetic price is implied from the options and where the actual stock is trading. The only difference between these two things is the interest rate. So this would be a reversal that you would trade and cost 74 cents, or you would take in 74 cents. This would be a reversal that you would trade that would cost 141, or you would take in 141 if you were to sell it. Now, I actually add another version to this. Remember, on this one, we talked about a 30-day conversion. Remember the example that I gave you about putting 100 grand into a savings account at these two different interest rates and how much you might expect them to be worth over the next 30 days. What would that difference be over 300 days? The concept of compound interest comes into play here as well. Again, we're talking about 4.32% on the left side, 8.32% on the right side, but this time we're talking about 300 days, almost a full year. Same exact computation, same exact calculation. We're just adding days. And so in this case, you can see timed expiration here is 300 instead of 30, but everything else is exactly the same. And so what you end up with is much larger numbers in this case. Why? Because it's compounded. We're still talking about 215 as the actual strike price, but in this case, you've got a difference that is much higher because of the compounding interest over time. Same thing is going to be true when you do it with 8.32%, except even more because the interest rate is higher and the 300 days. So the calculating the forward price here, remember, we're talking about 215 and the forward price is 227.41. That's a lot of difference. That's a big spread between them. So if we do the exact same math, do the same thing, the 4.32% interest rate, calculate the forward price, and then actually subtract the strike price, you're going to get the price of the reversal or conversion. Let's assume again that you're selling these as reversals. So you're going to be selling physical stock against them. So what you're doing is you're actually creating synthetic stock at 221.74. You're selling actual stock against it at 215. The difference is $6.74. That's quite a spread. Over here, obviously, the difference is going to be even greater, $12.41. So this is where the difference exists in the actual conversion or the reversal. This is one of those discount factors that I was talking about. If you look at something from a put call parity standpoint and it doesn't line up perfectly, you need to look at what the interest rate assumption is. And that includes what your interest rate assumption is, but also what the market's interest rate assumption is, because you can glean a lot of information just from where the calls and the puts are priced. Because the calls and the puts pricing are telling you what the interest rate assumption is for the marketplace. It's part of them telegraphing to you which one of those is more valuable, the calls or the puts, and why. One of the reasons why is the interest rate. First and foremost, the reason I chose those two interest rates is it's a big spread. I'm trying to drive the point home. 4.32 versus 8.32. Obviously, it's a big spread. But secondarily, as you add time, it becomes compound. Just like 100 grand in a savings account compounds the interest over time as well. The other thing that you need to see is that there's a difference in both the call and the put prices. It's not as if interest rate movement just moves one side or the other. As interest rates rise, generally call prices rise and put prices decrease. And as interest rates fall, you get the opposite of that. Call prices go down and put prices go up, usually. Changes in interest rates are going to show up in the forward price, in the price of the options. And it's going to be significantly more over longer periods of time because of that compound effect that I talked about. Higher rates and higher forward values are generally consistent with the ability to earn a higher amount on cash in that savings account that I talked about over that duration. So if you're assuming there's no dividends, the difference between the current stock price and the implied forward price that the options are telling you will generally reflect the amount of interest that you could earn if you were to take that same money and put it into a savings account over that time period. That's why the interest rates affect the calls and the puts in the way that they do. Because if they didn't, there would be some sort of free lunch scenario that would exist there. And as we all know, there is no free lunch. So that's what's happening with the calls and puts in that situation. That's why these forwards are priced the way that they are. Now let's talk about dividends, because that's the other discount factor you need to really take into account when you're thinking about this. The dividend effect on implied forward prices. So at the same time that you have interest rates doing their thing in the background on these implied forward prices, you will have certain scenarios, especially if you're trading stocks that pay dividends, where there are dividends that are included in some options, but not included in other options. Now, not in the same month, right? Calls and puts on the same strike are going to have the same exposure because they expire on the same date. If they're on the same strike in the same month, they're going to have the same exposure to the dividend, either the call side or the put side, because the dividend is paid on a certain date, right? It has an X date, it has a record date. You need to pay attention to where is the dividend and is it included in the options that I'm looking at that I'm using to create this synthetic stock position. So in much the same way that I showed you a 4% interest rate and an 8% interest rate, I'm going to show you a dividend, a $2 dividend, a big dividend, admittedly, scheduled to be paid before the options expire and after the options expire. All the inputs are the same, except the dividend is included in one and not included in the other. Let's take a look at how it affects the actual synthetic price. The actual computation is the same. Call minus put plus strike equals implied forward price. Here we have the dividend included, meaning the dividend is scheduled to be paid before the options expire. So in this case, we have a $2 dividend that's included here. Interest rate is 4.32%. This is a 34-day option. But the math is the same. Calculate the implied forward price. So you get call minus put plus strike. In this case, you have 892 for the call. You have 964 or 965 for the put. Plus 215 equals 214.27. That's with the dividend included. You'll notice the actual synthetic price is lower than the strike. I want you to remember that because we're going to talk about that in just a moment. Now we're going to do a little magic and show you that with the dividend excluded, how do you exclude a dividend? You just say the actual options are going to expire before the dividend is paid. And so in this case, you have a $2 dividend, but it's not included in the options. It's actually going to be paid after. And when you calculate the forward price here, what you show is a significant difference in the forward price because the actual dividend is not included in the forward price here. In this case, you have 949 for the call, 869 for the put, plus the strike. Remember, call minus put plus strike is the formula for implied forward. You get 215.80, which is above the 215 strike. Remember, the dividend included in this puts the synthetic price below the strike. The dividend excluded puts the synthetic synthetic price above the strike. So why is that? What are the effects of the dividend in this situation? When a company pays a dividend, generally the stock price drops by usually, depending on supply and demand, but usually the amount of the dividend, and it usually happens on the ex-dividend date. Since call options derive their value from stock price, if you put a dividend into a model, it's going to lower the call price and raise the put price. Again, you'll likely see the difference in both the calls and the put prices as dividend expectations rise. If you make dividends bigger, generally call prices go down and put prices go up because of the fact that people are making the assumption that when dividends are paid on the X date, the stock usually drops by the amount of the dividend. This affects the implied forward price, as you might imagine, through the prices of the calls and the puts. Now, consider also that in the case of these possible scenarios, the stock might be traded against these implied forwards. You might create a conversion or a reversal at the same price of the strike, the 215 strike. Depending on dividend expectations, you can create those in different amounts of spread because of the fact that the actual marketplace is discounting the calls by the amount of the dividend or increasing the puts by the amount of the dividend. So you're going to see, right? And that's not to say that the actual interest rates are not moving around in the background as well. They might be moving around in the background as well. It's not as if the interest rates move or the dividend moves, but they don't move at the same time. Sometimes you get a scenario in which both of them are kind of up in the air. And that's when the actual markets on these conversions and reversals will get, admittedly, probably kind of illiquid and probably pretty wide, relatively speaking. Early exercise is always something that you need to think about when you're trading something that might have a dividend in it. The reason why is that options don't get paid dividends. You only get paid dividends on stock positions. And if you're long calls and you want to receive the dividend, most of the time you have to exercise your call before the record date so that you are a stockholder on the record date and not a call holder, because like companies don't go through and figure out who owns the calls to pay their dividend. They go through and figure out who owns my stock. Who owns the stock on the record date? If you own the stock, you get paid the dividend. If you don't own the stock, you don't get paid the dividend. So people will exercise options in differing ways before X dates and before record dates in order to receive the dividend. Make sure you pay attention to early exercise risk. Again, early exercise risk only exists in American style options. Now, the vast majority of options that are traded in the United States are traded as American style options because they're equity options. But index options, European options, generally do not have American style exercise in them. So American style options are the only ones where early exercise exists. Now, conversions and reversals involve a stock position, which might result in the investor receiving or delivering a dividend payment. You also have to factor that in when you're talking about this, because if you're trading the conversion or the reversal, you probably have an actual physical stock position. And if you're long that stock and you're short the synthetic stock, you can see how one of those might get paid the dividend and the other one wouldn't. But you can also see how if someone had the opposite position on, they might be wanting to trade out of it if the dividend was changing. So that you need to allow to play into your risk profile as far as how you start to think about these when you're thinking about dividends possibly moving around in the background. So these are the two main discount factors that I built in: interest rates or cost of carry, and the potential of dividends to be paid or move around, and whether or not they're included in or not included in the actual options that you're looking at when you're calculating the implied forward price. So, like I said, the end of this had a lot of information in it. I hope that I was able to kind of distill it down into some somewhat easily understandable. Let's take a look at Q&A. So lots of people asking for the actual information as to the OCC and where a lot of this information is available. You can find all of our educational resources at optionseducation.org. You can see it down here at the bottom. Also, if you're looking for a copy of the presentation, I can send you a PDF of the presentation. You can send me an email, or you can send an email to options@theocc.com, which you'll see right here, options@theocc.com, where the investor education desk sits. We answer questions on options all day long, and that is something that we do all the time. So where can we find the calculator? That's a really good question. If you go to optionseducation.org, there is a pop out. There's a slide out menu on the left-hand side that pops out. It's under tools. And most, like I said, most people go there and use the options calculator. It's definitely the most popular tool, but there's an entire suite of tools there that are really great that we just overhauled last year. And so they're really fantastic tools. I recommend people use them. But you have to, in order to use the tools, you need to create a username and a password. The best part about the username and the password is that because we're fully funded by the OCC, we never charge anyone for anything. All of this education is given away for free at optionseducation.org. Make sure to check that out. So one question is, using mid price between bid and ask. The answer to that is yes. In every single calculation that I used or any example, I'm always using, if you see me using one price, especially for a call or a put, I'm not suggesting that I'm using the mid price between bid and ask. That's not always going to be something that you can trade at. The reason why I'm showing you this is to try to show you how the actual strategies work, not necessarily exactly how you're going to execute them. You should assume a certain amount of slippage anytime that you are crossing bid ask. And by crossing bid ask, what I mean is, as a market maker, I theoretically buy on the bid and sell on the offer. As a person who's trading against a market maker, you do the opposite. You buy the offer and you sell the bid. And so crossing bid ask means there's going to be some amount of slippage that's involved there. But oftentimes these spreads, conversions and reversals, are quoted as one singular price and traded as one singular price. So you don't have to execute the call and the put and the stock. You can actually quote it and usually trade it as one price. So what do you think, Jesus? I packed a lot into 46 minutes. I think you're muted.
I am muted. I was
There you
muted
go.
on my microphone, so thank you for that.
Yeah.
Yes, I think we covered a lot of information, Matt, and I also shared our team's email address there just in case somebody wants to reach out to the TradeStation team. Is education@tradestation.com. So make sure that you write that down and make a note of it. So in case you're looking for a specific piece of content, you can always let us know there. I think there's a question from Jim, Matt. Oh,
Let's
they
see.
want to know that's a platform with a one click. Yeah, if you're doing it on TradeStation, maybe it'll be more than one click. I'm not sure that you can do that with just one click, but if you can build the synthetic or the conversion strategy into Option Station Pro, it can be as easy as right clicking and closing the position, but then it does take a few more clicks than just one.
Oftentimes, it can be helpful
Yeah.
if you're able to create a strategy like that and then just look at it as a price. Remember, if you're looking at a conversion or a reversal, you're looking at it's essentially a spread trade. And what it really is an expression of the interest rate assumptions and the dividend assumptions that are involved in how the options are priced versus where the stock is. And so you can actually create it. And most of the time you can just create the spread and kind of like leave it up on your, on an options montage page so that you can look at it over time and
Mhm.
see how that price changes over the course of the spread trade, which I personally, I think that's interesting. Some people might not
Yeah.
think that's interesting, but it's out there.
It is. And actually, Jim, thank you for the clarification. Yes, you should be able to build that. Should be able, no, you are able to build that inside of Option Station Pro as a spread and then close it as a spread, submit it as a spread, and get executed as a spread,
Yeah.
all legs at once, for sure.
Yeah. Most of the time, those are available to trade as one price.
Correct.
Uh,
Correct.
One other thing, make sure when you're quoting these things, make sure that when you create them, that you pay attention to whether or not you're buying the call and selling the put and then selling the actual physical stock or the other way around. Because as I showed you earlier, and like I said, me as a beginning options trader, learning how to remember whether it was a conversion or a reversal was
Mhm.
sometimes hard. So I had to actually like create this little trick in my mind. But when you're creating that as a spread, pay attention to the fact that because if you want to be long the call and short the put and short the actual physical stock, make sure that's the way it's priced and that it's
Mhm.
quoted to you. So,
Correct. I'm also sharing the link to an article that our TradeStation team wrote on options conversions. It has access to a worksheet to help you find inefficiencies in the market and see if they can turn into trading opportunities. But I think that's all the questions, Matt.
yeah,
So
right on.
thank you so much for being accessible to our audience and all the questions that are here in the chat. I want to say that we do these webinars all the time, so make sure that you check the events calendar for upcoming sessions. We are going to have a Matt later this year, so keep an eye on his presentations if you like his presentation style. I know everybody enjoys it. I do for sure. So Matt, thank you so much for giving us your time. And I want to say thank you everyone for being here. Have a wonderful afternoon.
Thanks for having me. Have a great day.
Goodbye.